ARM Holdings is trading at exactly $256.73 per share during this active intraday session, marking a massive 15.05% spike upward and hitting a fresh all-time high. While the broader market watches this vertical trajectory with absolute awe, the real story isn't just the price surge itself, but a hidden structural shifts in how silicon intellectual property is valued. Wall Street is currently pricing this asset based on the assumption that every single server cluster built for artificial intelligence will pay a heavy toll to this specific architecture. But a quiet regulatory overhang suggests that the expectation of a friction-free monopoly might be about to collide with reality. The prevailing market narrative suggests that as massive tech giants accelerate their capital expenditure on cloud infrastructure, this business will act as an unpreventable toll booth, collecting high-margin royalties on every core deployed. Retail investors flooding onto popular online investing sites and using the Robinhood app are buying into the idea that this stock is a pure proxy for the massive server build-out happening globally. However, if you look beneath the immediate surface of the trading volume, a starkly different picture appears. The expectations are built on a perfect continuation of high licensing fees, but the reality is that major cloud hyperscalers are actively exploring open-source alternatives to minimize their dependence on proprietary architectures, creating a hidden long-term tug-of-war that most self-investing participants are completely ignoring. Looking at the immediate market activity, today's volume is tracking significantly higher than the rolling 30-day average, signaling intense institutional accumulation following a massive price target increase to $300 by Bernstein. This institutional momentum has completely overshadowed recent reports of a potential antitrust investigation by U.S. regulators regarding the company's licensing terms. When a stock experiences a massive double-digit intraday jump on the heels of sector-wide optimism, it creates a massive short squeeze that forces automated trading systems and retail users on various investing sites to chase the rally. For individuals managing an individual brokerage account or relying on automated asset allocation through Schwab Intelligent Portfolios, this type of extreme volatility highlights the difference between momentum and underlying value. The market is behaving as if there is zero friction in the growth trajectory, ignoring the fact that current valuation multiples are trading at a price-to-earnings ratio well north of 200 times trailing earnings. This level of valuation leaves absolutely no room for operational errors or delays in product rollouts. Institutional desks are using advanced platforms like the Interactive Brokers trading software to hedge their positions with complex option structures, while retail flows across the Robinhood stock trading ecosystem are leaning heavily into outright call options, betting that the momentum will carry the equity past the next round's psychological resistance levels. The intense options activity has created a classic gamma flip situation where market makers are forced to buy more underlying shares as the price rises, artificially accelerating the upward velocity of the stock. This intraday movement is a masterclass in market mechanics, showing how sentiment can completely disconnect from historical valuation guardrails when a sector is heavily favored by macroeconomic tailwinds. To understand why this momentum is so aggressive, we have to look at the broader ecosystem of online investment platforms and how retail capital is being directed. Platforms offering Robinhood Investments, SoFi Investing, and Fidelity Investments have seen a massive influx of capital directed toward a very narrow cluster of semiconductor companies. Investors utilizing individual brokerage strategies or building long-term retirement accounts through Fidelity IRAs are increasingly shifting away from broad-based index funds to place highly concentrated bets on single-ticker equities. This concentration of capital has created a massive liquidity tailwind from mega-cap technology names, ensuring that whenever a top-tier analyst reiterates a buy rating, a massive wave of buying pressure hits the order book across multiple platforms simultaneously. Whether you are executing trades through the Fidelity mobile app or running high-frequency algorithms via the Interactive Brokers platform, the liquidity characteristics of this stock have changed dramatically over the last 2 quarters, shifting from a tightly held low-float equity to a highly liquid institutional battleground. Comment below how many shares of ARM Holdings you currently hold in your portfolio right now, and let me know if you are buying more at these all-time highs or looking to take profits. When you strip away the immediate market frenzy, the core business model of this corporation is uniquely structured compared to traditional hardware manufacturers. The company does not actually manufacture, package, or distribute physical silicon chips. Instead, it operates as an intellectual property licensing powerhouse, designing the fundamental architecture, instruction sets, and blueprints that other technology companies use to build their own processors. When a tech giant wants to create a custom server chip or a new smartphone processor, they license the instruction set architecture from this company, paying an upfront licensing fee to access the blueprints and a recurring royalty fee for every single physical chip that eventually rolls off the assembly line. This asset-light model allows the firm to maintain spectacular gross margins hovering near 95%, as they do not have to absorb the massive capital expenditure, supply chain bottlenecks, or depreciation costs
costs associated with running multi-billion-dollar fabrication facilities. This model has historically given the company a massive competitive moat in the mobile computing universe, where their designs are utilized in nearly every major smartphone globally due to their extraordinary power efficiency. Over the past decade, this dominant position in mobile devices provided a highly predictable recurring revenue stream that funded ongoing research and development into higher performance computing sectors. Older financial reports show a company that was structurally stable but growing at a relatively moderate pace, deeply tied to the global smartphone upgrade cycle. The dramatic shift in valuation occurred when the company began successfully migrating its power-efficient designs from low-power mobile devices into high-performance cloud data centers and enterprise computing environments. This strategic pivot is the exact catalyst driving the massive divergence between past performance metrics and current market expectations. Traditional servers have long been dominated by legacy computing architectures that prioritize raw processing power over energy consumption. However, as modern data centers face severe electrical grid constraints and thermal limitations due to the massive power requirements of advanced cluster computing, the need for energy-efficient architecture has transformed from a secondary consideration into an absolute operational necessity. Major cloud providers are increasingly designing custom silicon based on these efficient instruction sets to lower their total cost of ownership and reduce power consumption across massive server footprints. This structural transition has allowed the company to command significantly higher royalty rates on enterprise-grade chips compared to the nominal fees collected on standard mobile devices. For investors scanning investing sites or utilizing tools like the SoFi Robo-Advisor to build balanced portfolios, understanding this transition from mobile architecture to data center infrastructure is critical to evaluating whether the current premium valuation is justified. It is not just about selling more licenses, it is about capturing a fundamentally higher percentage of value per chip deployed in the cloud. As we look toward the future outlook, the long-term investment thesis for this stock will be decided by how successfully the company can defend its high-margin licensing model against emerging structural threats while continuing to expand its footprint in the enterprise server market. There are two primary scenarios that could unfold over the next 24 to 36 months. In the optimistic scenario, the company successfully establishes its latest V9 architecture as the absolute baseline standard for next-generation cloud computing and artificial intelligence accelerators. Because the V9 architecture commands roughly double the royalty rate of the previous generation, a widespread upgrade cycle across cloud infrastructure would trigger an exponential increase in high-margin royalty revenue without requiring a corresponding increase in operational expenses. This outcome would allow the company to rapidly grow into its lofty valuation multiples, rewarding long-term investors who manage their positions through sophisticated Fidelity wealth management strategies or advanced individual brokerage accounts. Conversely, the pessimistic scenario involves a dual threat of regulatory friction and aggressive open-source competition. The ongoing antitrust investigations into the company's licensing practices could force a structural modification of how they collect royalties, potentially limiting their pricing power or forcing more transparent, lower-cost options for licensees. Simultaneously, the rapid maturation of RISC-V, an open-source instruction set architecture that requires no licensing fees or royalty payments, poses a legitimate secular threat to the company's long-term market share. Major technology firms are actively investing in the development of open-source silicon to completely eliminate their reliance on proprietary third-party blueprints. If the open-source alternative achieves performance parity in enterprise applications faster than Wall Street anticipates, the company's projected revenue growth could decelerate sharply, causing a massive recalibration of the stock price. For everyday market participants using online investing tools, managing self-investing assets, or trading via the Robinhood app, this risk highlights the importance of matching investment horizons with structural realities. The tension between the short-term market expectation of an uncontested chip monopoly and the long-term reality of intensifying architectural competition will ultimately dictate the trajectory of this asset. When navigating these volatile high-tech sectors, relying on comprehensive platforms like Fidelity Investments or utilizing individual brokerage tools through Interactive Brokers can help investors maintain tactical discipline. In summary, the central insights surrounding ARM Holdings reveal a company experiencing an extraordinary operational expansion driven by a structural shift toward energy-efficient cloud infrastructure, yet trading at a valuation that demands flawless execution. The short-term market expectation is heavily influenced by spectacular price target increases and intense momentum, pushing the stock to all-time highs during today's session. The underlying reality, however, is bounded by real regulatory scrutiny, high valuation multiples, and an emerging open-source architectural challenge that could alter the competitive landscape in the years ahead. Balancing these distinct forces is what separates successful long-term capital allocation from short-term speculative trading in the modern technology ecosystem. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.